Hey everybody, good to be here today. My name is Brent Morse. Oh, I don't know about you, but I've had an exhausting week in trading. It's been the market volatility. I'm ready for a weekend, but we're not quite there yet. Time to talk about advanced options. Today, I want to talk to you about 7 different things that maybe you could do to help kind of manage risk in your portfolio. Consider, and when I go through these, it's not you need to do every one of these, but it's things for your consideration as you're going forward, trying to manage your portfolio, especially in light of, what comes to mind in my mind is, kind of market turn down. Of course, we don't always want to think about risk only when the market's already turning down, but we'll put this out there for you today. Glad you're here. I'm also glad to be joined by Barb Armstrong, who's helping me out in the chat. So appreciate her. She's wonderful, and make sure you check out her classes, including managing a smaller portfolio. If you have a smaller portfolio, check out that class. So that's Barb Armstrong. You can follow her on X. You can follow me on X as well, at Brent Moore CS, at Barb Armstrong CS. And before I get to the main content, though, let me go through some quick disclosures that we need to go through. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only and should not be considered an individual recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. The paper money software application is provided for educational purposes only. I may not factor in commissions in the examples I show you, but just realize that is an important thing to consider. All investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And there's no guarantee an execution of a stop order will be at or near the stop price. So there we go. Let's take a look. Let's go to the Thinkorswim platform here to get us started off. And I'm going to pull up the S&P 500. Let's just kind of talk about this pullback that we've had on it. This current pullback, if I were to measure that, how far down are we? About 7%, I think. It's going to make me do this. Okay, let's try that again here. Let's see where we're at. About 7 to where we are now, because we've actually have kind of like a little hammer candle right here. About 6%. It was down closer to 8% by the low of the day. And for those of you who are looking for a bounce, well, bounces start, I don't know, if we've seen a low or not. I'd probably say, hey, look, we had these were kind of lows. Do we have 2 lows back in this area? Just doing some technical analysis here, folks. And this is kind of a key, probably a fairly key technical level that I think some technical traders would consider. Well, we certainly tested it. In fact, but went below it today. But that's kind of a hammer candle. And of course, we still have, 2 hours left in the trading day. I don't know where we're going to end up today. It may reverse itself. Boy, we've seen some whipsaws this week. But that would actually be a pretty good sign given what we have here. So this is ever changing. I looked, a half hour ago and it didn't look like this. So, there we go. But the first strategy, and so my point is, we've had this pullback. And so we'll look at some historical pullbacks a little bit later. But one way to try and help manage risk, and so this is our number one thing, is to use either defined risk strategies or limited risk strategies. So there may be times where you strategically ignore this, but just as a practice that a lot of traders find to try and help reduce their risk, that a lot of traders find to be helpful, is to use limited risk strategies. Let me give you an example. Let's say you're bullish on a stock. I'm going to pull up CMCSA. I'm going to pull up Comcast here today. Okay. So we had some resistance there. We broke through that. This looks like a breakout. Now, whether that's going to continue, I don't know. But we're now above both our 20 and 50-day moving average. Our 20-day moving average is sloping upwards. We had a what I think a lot of traders would consider to be kind of a support type bounce here. And so let's say you're doing a bullish trade here on this. And you could do, let me give you a choice here. Let's say we're doing a short put versus a short put vertical. So if I go to the trade tab and I'm going to look here, I'm going to go out not super far. I'm going to go out, we'll just go out just a couple weeks here on this. And I'm look at, say, my delta here is we'll go about 30 delta, okay? So delta measures how much the option moves in relationship to the stock price move, but it also kind of gives us a sense for how far out of the money it is. It's changing. In fact, let me go up to this 37 delta here. I'm going to go a little bit closer. I'm going to look to sell this. Now, I can do this, and this is certainly a valid trade. There's benefits and detriments too to this, but one of the benefits is we get a full $48 credit on this. And but if I click on confirm and send and look at this, look at my max loss, 3,600 and change. That's a fair amount of money. Now, that's great because I get that 48-cent credit on that if I sell that. But if at the same time I sell that, if I go to, say, make it a vertical spread and buy that, I'm lessening my credit. I'm now down to a 28-cent credit. But let's look at, if I click on confirm and send, what's my max loss? $71 is a very big difference. Technically, a short put isn't a theoretically unlimited max loss, but it can be a very large max loss. So by layering a bunch of different strategies in, reducing that risk, whether we use stop losses, which we'll address in a little bit or not, whether we use stop losses or not, by limiting those, it may be worth it even though you're eating into some of your potential profits there, okay? Now I'm going to do this. I'm going to go and just add another, we'll make that 3 contracts, how about, okay? I'm going to confirm and send, and now look at this. 3 contracts, my max profit is higher than what we were looking at before for just the single contract. My max loss is still much, much, much less than that's a theoretical max loss. And just remember, short options can be assigned early. So what I'm going to do is I'm going to put that in my short verticals area, and we're going to throw that in the account there. Okay, so that was number one. Number one strategy is use defined risk strategies, limited risk strategies in your trading. Number two, be aware of your delta for your portfolio. You can look at your overall delta. So it can be a little bit tricky sometimes, even if you beta weight this. Okay, we've talked about this in the past. Even if you beta weight this, if you're in these groups, you kind of get the subtotals. But what you can do is you can go up to the little 3-line menu right here, uncheck show groups if they're all grouped, and then you can see a total for your portfolio there. So be aware of what that total beta weighted delta. Now I'm beta weighting to the S&P 500 here. So this beta weighted delta is showing 1280. Okay, so 1280. So what that means is every point drop in the SPX, we're going to expect approximately, and that's all it is an approximation, a 13-point drop in the portfolio. And you may go, well, $13 drop in that portfolio. Well, $13 doesn't sound like much, but keep in mind when we're talking about the SPX, this, just a 1% move in this is about $57. So I don't have there's my calculator. What would we say? 13 point times 57, a 1% move is going to be about a $740 hit to your portfolio on that. So what I want you to do is I want you to be aware of that delta. I don't know how much your delta should be. I'm not saying you need to have a negative delta or a neutral delta. Maybe you want a very high delta, but just be aware that affects your risk. And if we want to reduce some of that, you may consider maybe closing out some positions. So for example, let's take CVX. I have 100 shares. Now this isn't an option trade, but this is contributing a 1.27 to this overall delta right here. So if I go out and I just say, well, I'm going to get out of this position and close out of my Chevron position, we're up a little bit on it right now. I think $377 or something like that. Oh no, I take that back. $80. We're up on that. I'm going to close that out, but I'm just going to make sure I get out. So I'm just going to do market. I'm going to get out of that, send that. Let me get rid of that. And now, when I look at my portfolio, my overall delta has then been reduced. That's an easy way to just get out of your, to lower the risk of your portfolio. Be aware of the delta and perhaps, you can possibly look to take it out, take out positions to reduce that delta. Now, my third one is kind of related to the second one, and that is evaluate your winners and consider selling them if it's going to help you reduce that risk. Tesla, I have a long put. We've made some good money on that. Maybe its course has run, and I'm gonna take that $290 or so and close that out. So look at your overall delta. Look at those that have the highest, well, maybe not the highest, but significant impacts on your delta. Consider reducing those. And if you've made significant money on those, then you may consider getting out. In the case of Tesla, I have a long put. I have a stop loss on this. I'm just going to cancel out of this stop loss. And then what I'm going to do is I'm going to sell my put here. I'm going to create a closing order. We're going to sell that and confirm and send that trade. Okay. So now we're out of that. We're going to take advantage of our winners there. Okay. And get rid of those. Number 4, consider hedging your portfolio. We talked about looking at that overall delta there on there, but you can, instead of just getting out of positions in your portfolio, you can look to actively add some positions. Now, about, 3 weeks ago, we said, we're a little bit worried about on this. We're a little bit worried about this, okay? We're a little bit worried about it, and therefore we're going to throw in a hedge. Sure enough, we did. We put in XSP. Okay, when did we get in this hedge? We got in it on the 19th of February, and there was a reason for that. We were a little bit concerned, and this actually has, this has been a rough, do I need to tell you it's been a rough couple weeks in the markets here? This has actually saved us a couple $1,000s in this paper money portfolio, admittedly, of what it otherwise would be. So that's a hedge, and this happened to work out quite nicely in this circumstance. It doesn't always work out that well. You may look at something like this and go, oh, that was very nice. I'm just going to permanently keep a hedge on that portfolio. But keep in mind, this has a negative theta, okay? A long put has a negative theta. In other words, if everything else being equal, this is decaying. This is going to be losing some money if taking into account any movement, portfolio stock movement into market movement into account. So that negative theta can wear, and over a short period of time, it's probably not going to wear much. But if you just leave it as a permanent portion of your portfolio, that can be a problem. Furthermore, if your assumption is that the portfolio is going to go up in the long run, and hence why you have a delta, a positive delta perhaps in your portfolio, then you're bullish. And this is going to go down in value, much more than just what theta is going to do to it. This hedge is going to go down in value if the portfolio does kind of what you expect. So my suggestion would be this. Consider the circumstance, okay? Now, I can't tell you what circumstances you're going to put it in or not, but you may strategically decide there's certain times when you want to protect your portfolio more against risk and add on a hedge. That hedge could be a long put on an index, such as we have here. This is the XSP, which is similar to the SPX. It's just 1/10 the price. Because when we looked at it a couple of weeks ago, we looked at the SPX, and the SPX was just too much for my portfolio. Now, in hindsight, with how much the market has dropped, it actually probably would have been pretty good to put a hedge on, put it on the SPX. But of course, we're not gifted with hindsight here on our trades. So we need to do what makes sense for the size of the portfolio. So if you are interested in that, you can go back and look at our class. We did it in a class, I can't remember, but on 219 I did that. And I think it was in this class, could have been managing an option portfolio as well, I guess. But 219, we did that trade in a class. Now, these aren't permanent. I have 35 days to go to expiration. Depending on the market, let me go to SPX here. Depending on the market, I may decide to take that off. This candle right here isn't enough at this point for us in this class to say we're going to remove that hedge. And so I'm going to leave that on there. But that's the fourth way to do it, is to just consider adding hedges to your portfolio. Fifth one, and it's one you hear all the time, add stops. Now, you've heard me say it many times. You've heard Barb say it many times. Stops do not guarantee you're going to get out exactly where you put the stop on. But you can use stops to help protect yourself. Let me give you a few examples here. On Visa, I have a Leaps call on Visa. Leaps long-term, Leaps are long-term, and it's intended to be a long-term bullish trade. Let's see, what's our expiration date on this? I don't remember. It's June of 2026, so over a year away. Our intention is to hold it a longer period of time. But if you were in my class just a couple days ago, we moved up our stop on this. We moved that stop up to 60 on this to try and take advantage and say, hey, look, if the stock drops down here, if it drops enough, we're actually going to get out of this Leaps call here on this. So be diligent with your stops if you are going to use stops, and consider moving those up if you like. Now, question from Alex. Can this be assigned early? No, this can't. This is actually a European style option, this XSP. Most index options are. The only one I can think of that is not a European style index option is the OEX, is an American style. So this cannot be assigned early there. Good question, though. So, but let me give you a different illustration. And this is going to go back to a trade we did last week in this class. If you remember this class last week, we did 2 back ratio spreads, okay? And you're going to like this because they completely went disastrously bad on us, okay? We did a trade on Merck, okay? We did a bearish trade on Merck. And so that was a week ago. We were kind of expecting this bounce here, I think, on this as a resistance level to hold. Well, what has Merck done since then? We did a bearish trade, and Merck has just gone straight up for us, okay? We did another trade, another back ratio spread. So my 2 examples last week fell flat on their face. We did a bullish trade, assuming this support level was going to hold on Citigroup. And what happened to Citigroup? It went in the toilet, man. It was just terrible. It just went bad on us. So we completely guessed wrong on those. But let me just kind of explain it this way. We put on stop losses on these, okay? Merck, for the Merck trade, this was a back ratio spread, so it was a debit spread. We paid $871 to enter this trade, okay? We had a stop on it, and we closed out by selling it for $500 and I wrote this down, $564. Okay, so the net result was a loss of $307. Okay. On Citigroup, these are painful to recount here. We had an $828 debit. I'm not factoring commissions here. We closed it out by selling it for $491. Okay. And we closed it out like 2-3 days ago. Okay. And so our loss on that was $337. Okay. So that's where the stops come in. This is Citigroup. This has not gotten any better. It's just gotten worse and worse. And so, the debit, 871 and 821 were our theoretical max losses on these. But we limited it to 307 and 337. Now, I don't like taking 307 losses or 337 losses, but that's the role of our stop loss. Whether you're doing the stop loss just based on the option price or doing it in terms of like not technically a stop loss, but it's just a rules-based contingent order based on the stock doing something, it can get you out and it can help save you. It's not a guarantee to save you because look, if this went from here down to here in one day, we'd probably be near a max loss on that. So there's no guarantee on the stops, but it is something I want you to consider in your trading there. Okay. Here's the next thing I want to talk about. And this one is going to apply perhaps even more to stock investing than options, but I'm assuming all you option traders out there, well, most of you option traders out there at least, are likely looking at maybe have investments in the stock market as well. If you're an options trader, maybe not, but most do. And so the next item is diversification. And I just want to kind of talk to you about how you can kind of consider diversification in your portfolio. So one thing is use the tools that are available to you. On this Thinkorswim platform, I have this position statement here, and you have these different columns you can add. I'm going to go to this little gear right here, and I'm going to add a column for sector. Okay, I'm going to add a column for sector. I'm going to put this in, and I'll just leave it on the right there. So here's my sector column. Let me see. No, that didn't do it. We'll do that. Okay, shows it enough. So particularly when you're looking at your stock trades, how much are you allocated into any one sector? There's 11 sectors out there, folks. 11 kind of common sectors is how we usually categorize it. And if you are in one or two sectors, that certainly can help you if you happen to pick the sectors that are going up. That's great. But as we've seen, and you've seen, I'm sure, there's times when the market can certainly turn on a dime, so to speak. And so basic diversification is a way to try and help protect your portfolio. It's not a guarantee, right? When the market's going south significantly, a lot of times all sectors will be down. But you'll have some sectors that are down less than others. So for example, lately we've seen things like healthcare and consumer discretionary, even if they've been down a little bit, they've been outperforming the rest of the market. Okay. And so there you go. that would be, something I would consider for you to do there. Okay, let me go. So really, if I want to change these columns, George is like, I'd like to switch these around. I allocated. I need to do the right amount of space for each of these here, and that way, sector just takes a little bit more room there, and then you just want to be able to see each of these. Ultimately, I've got a bunch of columns here. You could add fewer columns to try and help you out as well. Here's another thing to try and determine which sectors, a lot of times sectors are going to go kind of lockstep with one another. And so the challenge becomes, you're diversified into a few different sectors, but they kind of do the same thing sometimes. So another way to approach it is you can do this. You can go to your sectors and you can kind of look and see, or stocks that you're in, and before you buy a stock, consider the correlation of that stock to the S&P 500. So you can add a study, one of our studies up there, just go to the flask up there. One of those is correlation. And you can pull up this correlation, and correlation is going to tell you how much this stock, I'm just going to bring up a few different stocks here. Let's go to here, and we'll go to some that I have in my portfolio. Here's Goldman. How much has this stock, how correlated is it? Let me go a little longer term here. We'll go 3 year. How correlated is this to the rest of the market? Okay. And the answer is this. Look at the scale. The top of the scale is 1. A correlation of 1 would mean basically it moves lockstep with the S&P 500 here. Okay. Theoretically, the scale could go all the way down to -1. That would be off my screen here, but and we haven't hit that. That would mean it goes just opposite what the S&P 500 does, and a correlation of 0 is going to mean it's completely independent. What the S&P 500 does tells us nothing about what Goldman is going to do in this example. So those stocks that have higher correlation, in other words, they spend more of their time above, say, maybe the 0.6, 0.7 level up there, they're going to be, those are fairly highly correlated. Stocks that are down lower on this, something 0.5 or less, are going to be lower correlated assets. So again, this last point I'm kind of talking about here isn't as much an indication of for options as it is for stocks, but I think I would be kind of negligent not to mention this in terms of overall risk management in your portfolio here. So you can kind of look at correlation and how they go. You can also do this, by the way, on sectors. Let's go to our sector indices here. And you can see, look, here's energy, and you can see how energy is much less correlated. It spends a lot of the time, here's 0.5, a lot of the time between 0.5 and 0, or even negative, as compared to, say, industrials. The vast majority of the time, it's over that 0.5 level. We had that one little dip there, but you can do that for each of these sectors here and get a sense. There's staples, and this is discretionary right here. And discretionary is going to be more highly correlated than staples, okay? And utilities tends to be lower correlated, and real estate tends to be lower correlated, and so on. So I don't want to belabor the point, but diversifying your portfolio and getting into different asset classes was our sixth step. Okay, let's move on to number 7 here. Okay. Be aware of your total portfolio risk. Now, I already mentioned that to a certain extent when I talked about delta, but use the risk profile tool to help you with that total portfolio risk. So let me go, I'm going to pull up SPX, okay? And let's talk about this drop, because we said we've had about a 6% drop here. It was 7, close to 8% here. how big of a drop is that really? Let's go to a 3-year chart. Do I have a 3 years? A 3-year chart. And what you can do is you can kind of measure past moves on here and see what kind of drop we've seen. And so that drop back in 2022 was just maybe a little bit shy of a 20% drop. This is on the SPX, by the way. The NDX, the NASDAQ, is probably going to show a more substantial drop. The Russell 2000 will show probably more substantial drops. But this is on the SPX, when I'm looking at that, so we had about a 20% drop there, about a 10% drop there in 2023. 2024, what was our biggest drop? It was, what do we got here? Just under 10% here. So how much of a drop can we expect? Well, I don't know. The market could theoretically go to zero tomorrow for all I know, but let me just kind of give you a sense of this. And you can kind of see this a little bit on these more near-term drops. 10% drops are pretty commonplace. Most years have a 10% drop somewhere along the way there. Not every year, but so don't be surprised when you see a 10% drop. We didn't quite get that this year. And look, this has been kind of a panicky time this week, hasn't it? So don't let it shock you is number one. What about a 20% drop? And this is every several years, you'll get a 20% drop. Okay. We saw that back here. Okay. Every several years, we get a 20% drop. What about a 30% drop? Well, I don't have one on the chart here, but how often do we get a 30% drop? Oh, about every 10 or 12 years or something like that. You get a 30% drop in the portfolio. When was the last in the S&P 500? When was the last one? COVID. COVID, we had I think it was like a 38% drop, if I'm not mistaken. I'm not going to take the time to measure it out right now. That is, so that was 2020. What about before that? When was the time before that we had a 30% drop? Well, the financial crisis, 2008, we had about a 30% well over a 30% drop at that time, okay? That was closer to a 50% drop. Before that, we had the dot-com bubble. Remember, for those of you old enough to remember that? Yeah, sure. So the point is, prepare your portfolio for this risk. Now, I mentioned using the risk profile tool. This is going to be kind of an addition to, I did a tutorial a couple weeks ago in this class on using the basics of the risk profile tool. I'm going to go a little bit beyond that in this class here. And I just put a link. For those of you watching on a recording, that class was on 2/21. So that was 2 weeks ago, 2/21, we did that. And so you can just go to the playlist. I think Barb actually she posted the playlist here. I just posted the actual video itself. But if you are on Trader Talks, so that's just a reminder, everybody should subscribe to the Trader Talks channel. If you're on Trader Talks, go to the playlist for this class and go back to 2/21. You'll see that class for basic risk profile stuff, because we're going to go beyond that just a little bit. Question from Alexis, is there a tool to measure on the chart? What I did is I just used this diagonal line tool, and when you draw on that, it kind of gives you that percentage. As I move my cursor, you're going to see that little box there? That gives you how long that is, okay? How long that line is that you drew. All right? So I'm hoping that answers your question there. Let me just clear that drawing set and get rid of some of those lines there. Okay. So let's go though to our Analyze tab. I'm on Risk Profile. And let me close this down. Let's look at this. And each week, pretty much, we look at something in the Risk Profile tool. But you can look at your whole portfolio and help measure the risk of your whole portfolio using this tool. So what you do is, first of all, I'm going to use SPX again. That's going to be your benchmark. It doesn't have to be your benchmark. You can use something else. But go down here where it says single symbol and click on portfolio beta weighted. Okay. Now, here's my portfolio right now. Okay. And today is the 7th. So that's going to be this kind of purple line here. Let me just do that. Is that going to change? That's not going to change it here. Okay. Here's the 7th. So this is where the current market is, 57.76. This little kind of whole dashed line right there. Let me just scooch this down a little bit, make it a little bit bigger for you. Okay. So this is what our portfolio looks like right now. But what we can do is we can say, what if the market drops 10%? Well, we add a price slice in. If you don't have any slices in there, you can, let's say we don't have a slice there, okay? We're going to delete slices, okay? And you can always just add a slice if you want by clicking on the plus sign. And then you can adjust it to whatever you want. If I want to see what would a 20% drop in this go, I'd put in I'd make that a percentage, and I'd put in minus 20. Okay. Now let's look at what this portfolio would look like minus 20. And actually this one I'm going to just make this the current price. Okay. So our portfolio right now is showing about a $7,700 gain right now on our current positions that we're in. But if this were to drop 20%, we'd go all the way to zero, beyond zero, to about a $7,500 loss on this portfolio. Now you may go, well, 20% is a pretty drastic move from here. Well, let's change that. Make it a 10% move. What would a 10% move down from here make it? And you can see right down there, that would wipe out all the gains that we have existing in our portfolio right now. So earlier, when I've talked about things like adding stops, adding hedges, closing out positions to reduce risk, controlling your delta, reducing delta, using defined risk strategies. All those are meant to help protect you if things turn against you here on this, okay? So use this tool. You can put whatever slices you want. You can also see kind of graphically, is this portfolio bullish or bearish? Well, it's a bullish portfolio because we're going up from left to right. If this is too much for you, then what I'd like to see is I want to mellow that line out there, make it reduce the slope on that line there. Okay, so let's just throw in a trade here to finish off that is going to maybe, with some of the principles that we have in mind today on here. So I'm going to go and make this back to single symbol. I'm going to go to add simulated trades. So let's say I want to do a trade that is going to add to this portfolio, but I'm a little concerned about the market here. I still want to do something that's a positive theta trade, okay? And I'm going to do this on the whole portfolio. So I'm going to do on a whole index. So I'm going to go to the SPX here. I'm going to do something that's positive theta. I'm going to make it kind of negative delta though, in case we drop a little bit more. I want that to benefit us. I'm also going to say, I'm going to do something that is negative vega, okay? Negative vega, why? Because if we look at things like the VIX here right now, we see it's spiked up. And so my expectation, and the expectation for this class, I don't know, this could stay up, it can go up, and it can stay up. But the assumption I think we typically use in this class is that when it spikes, it doesn't stay elevated forever, okay? not just forever, but it usually doesn't even stay elevated for a few weeks. So the expectation is that we're going to go by here in this class is that implied volatilities are going to drop here. So I'm going to do a trade that is positive theta, negative delta, negative vega. So that kind of rules out a lot of trades. But what I want to do is I'm going to do this on the SPX. I'm going to just do analyze, add simulated trades. We're going to go to SPX here, and I'm going to do a butterfly spread. Okay, just so you know, this is advanced options class, so I like to illustrate those. I'm going to go to March 28th here on this, and I'm going to go out of the money a little bit. I'll go to the 540 as the middle strike. Let me get some more strikes here. Let's do 30 strikes. Okay. So I'm going to go to 540 as the middle strike. So I'm going to just switch this to butterfly, and we'll tweak the strikes here once we add them in. But I'm going to go to 540, and I'm going to buy that. Let me move this up here. Okay, so here we go. Butterfly spread, our middle contract is 540, and then I'm going to go down to like 510 maybe. And then what we're going to do is we'll tweak these a little bit. If you keep them too narrow, like these are 5 points from the middle, if you keep them 5 points from the middle, your profit area is going to be so narrow, you're going to have no wiggle room on this. Okay, and I'm going to go up, we'll go up 30. So, because we went down 30 from 5740 to 5510, that's a 30-point difference. I'm going to go up 30 to 5770. And let's just take a look at that. Okay, so, oh boy, what do we got here? Oh, I have other trades on here. Let me go and why this is not looking right here. There is something. 5770. Oh, hold on. That shouldn't be 5510. That should be 5710. Okay, let's try that again. 5710. I knew that wasn't looking right there. Okay. There we go. Thank you, RG's like, yeah, you blew that. Yes, I did. So there we go. And that's I could tell. Thank you, RG. I could tell I blew it even before I saw RG's comment because it didn't look right. A normal butterfly should be symmetrical, and it was not symmetrical. So here's our butterfly spread right there. That means we want the stock to stay somewhere in this 540 range, go down to about 510 and up to about 570. The potential gain, in other words, the difference between where we're at, and it's a moving target, between where we're at and our break even is much greater than what we potentially risk on each side. So that's our risk there. That's what happens. Okay. And so so this is going to be in the money. These are SPX options. Okay. I'm not going to let this. So Thea says, what if it goes in the money and it's assigned? These are SPX options. They can't be assigned early. These are European style options, first of all. Now, at expiration, yes, but we're not going to hold it to expiration in that case. So there's that as a potential, that's kind of hedge. Now, if I wanted to, what I could do is I could skew this a little bit more bearish or bullish here. We've talked about this in the past, but instead of keeping these, I could make this a broken winged butterfly, and I could move this up a little bit. So instead of 5770, I can go to let's do 80 and take a look. Now I have no downside if the stock goes down and down and down. Okay. If the stock goes down and down and down, it's in great shape for us. Okay. the lower it goes, because we're at profit. We're at a $480 profit no matter how much it goes down there. But we've added to the upside risk on that. Okay, so there you go. You can consider skewing that if you want. I'm going to go and I'm going to make this actually, I'm going to leave this as it was. And I'm going to right click on this. I'm going to confirm and send. And we're going to put this in. It's not giving me a choice there. We'll just click on send and send that order there. Okay. All right, everybody. Let's just recap here as we're wrapping up. Today, I talked about several different approaches to try and reduce the risk of your portfolio. This isn't just applicable for when the market's going against you. It's for even before the market's going against you, to try and help reduce your risk in your portfolio. I want to thank Barb for helping me out in the chat today. Of course, I want to thank you for joining me. Coming up next, we have ThinkScript Studies. Check that out. After ThinkScript Studies, we have Market Movers, which I'll be actually teaching today as well. I'll be in for Ben Watson today on that. Thanks for joining me. We'll see you all same time next week. Bye-bye, everybody.